What if I told you that every 10 to 15 years, the global financial system commits suicide, and we the investors are just collateral damage in a game rigged by greed, manipulation, and human psychology? Over the last 100 years, markets have crashed not once, not twice, but dozens of times. Each crash destroyed lives, toppled governments, and reshaped entire economies. Today, we are diving deep into the bloodiest financial disasters in history. From the world's first recorded bubble crash to the modern day digital massacres. Buckle up, because this isn't just financial education, this is a thriller. The birth of financial insanity. Our story begins in 1637 in the Netherlands with flowers. Yes, you heard it right. The world's first recorded market crash was caused by tulips. Picture this, at the peak of Tulip Mania in February 1637, single tulip bulbs sold for more than 10 times the annual income of a skilled artisan. Some bulbs cost as much as a nice house, around 5,000 guilders. People mortgaged their homes, sold their businesses, and borrowed against their future just to buy flower bulbs. Then came February 1637 at an auction in Haarlem. The first offer of bulbs received no bids. Prices were lowered, still no bids, and suddenly tulips were worth no more than onions. This wasn't just a market correction. This was a financial apocalypse. Families were ruined, the Dutch economy collapsed, and thus began humanity's love affair with financial bubbles. Chapter 2. The Great American Nightmare. Fast forward to 1929, America. The roaring 20s were in full swing. Everyone was getting rich in the stock market. Sounds familiar? October 24th, 1929, Black Thursday. The Dow Jones had climbed from 63 points in 1921 to 381 points by September 1929. People thought it would never stop climbing. They bought stocks on margin, meaning they borrowed money to buy more stocks. Then reality hit like a freight train. In one day, the market lost 11% of its value. By October 29th, Black Tuesday, panic selling had begun. The Dow collapsed from 381 to 198 points by November. That's a 48% crash in just 2 months. But here is the terrifying part. This was just the beginning. The crash triggered the Great Depression. Unemployment hit 25%, banks failed, people lost their life savings. The American dream became the American nightmare. And the world learned a harsh lesson. What goes up without reason comes down without mercy. Chapter 3. The Indian Awakening and its Dark Side. Let's jump to India, 1992. Economic liberalization had just begun. The Bombay Stock Exchange was awakening from decades of socialist slumber, and into this naive market walked a man who would become both a legend and a cautionary tale. Meet Harshad Mehta, the big bull of Indian market. Between April 1991 and April 1992, Harshad manipulated stock prices like a puppet master. AC stock price rose from 200 rupees to 9,000 within a short period. Think about a 4,400% return. Here is what really happened. Harshad Mehta engaged in massive stock manipulation financed by worthless bank receipts. He exploited loopholes in the ready forward deal system, siphoning funds from interbank transactions to artificially inflate stock prices. The total scam amounted 4,000 crores, about $1 billion in today's terms. Mehta had essentially turned the entire Indian banking system into his personal ATM. When the scam was exposed in April 1992, the market didn't just fall, obliterated. The BSE Sensex crashed from 4,467 points to 2,529 points by August, a 43% fall that wiped out entire family fortunes. The psychological impact was devastating. Indians learned that markets could be rigged, manipulated, and used as weapons of mass financial destruction. Chapter 4. The dot-com delusion. Jump to 1999 to 2000. The world had discovered the internet, and everyone lost their minds. Companies with no revenue, no profits, and sometimes no actual product were valued at billions of dollars. Pets.com spent $300 million on marketing and sold $619,000 worth of products. But hey, they had a great website. The Nasdaq, loaded with tech stocks, rose from 1,000 points to 1995 to over 5,000 points by March 2000. People quit their jobs to become day traders. Everyone was going to retire by 35. Then reality knocked on the door with a sledgehammer. From March 2000 to October 2002, the Nasdaq lost 78% of its value. $5 trillion in market value was wiped out. Companies that were worth billions became worthless overnight. Entire retirement funds evaporated. But the lesson nobody learned, this was just a rehearsal for something much, much worse. Chapter 5. The 2008 Apocalypse, the year that almost ended capitalism. It started with a simple idea: everyone deserves to own a home. Banks began giving mortgages to people who couldn't afford them. These subprime mortgages were then packaged into complex financial instruments and then sold worldwide. Housing prices doubled between 2000 and 2006. People bought houses they couldn't afford. Banks didn't care because they sold the risk to others, and rating agencies gave AAA ratings to financial garbage. Then the music stopped. Lehman Brothers, a 158-year-old investment bank, collapsed overnight. AIG needed $85 billion to survive. Bear Stearns vanished. The S&P 500 fell by 57%. But here is the truly horrifying part. This wasn't just about 6 million Americans lost their homes. Unemployment doubled. $11 trillion in market value was destroyed globally. The financial system didn't just crash, it nearly died. And governments had to print trillions of dollars just to keep the world economy alive. Chapter 6. The 2020 digital chaos, the Indian market mayhem. March 2020, a virus from Wuhan didn't just shut down China, it brought the entire Indian economy and the world to its knees in a matter of days. The Nifty crashed from 12,430 points to 7,511, a brutal 50% fall that wiped out 50 lakh crores of investors' wealth. The Sensex followed suit, collapsing from 42,000 levels to 25,981. Half of India's market cap gone in weeks. And here is where it gets bizarre. On March 24, 2020, the exact day PM Modi announced the world's largest lockdown, Indian markets began their most spectacular recovery in history. Go check the chart. Wait, let me get this straight. The day the entire economy shut down, the market started going up. How does that even make sense? Suddenly, with offices closed and people stuck at home, trading became India's new favorite pastime. Housewives, college students, unemployed professionals, everyone became a stock market expert overnight. Discount brokers like Zerodha saw account openings explode by 300%. Trading apps crashed from overuse. WhatsApp groups turned into stock tip exchanges. But here is the most shocking twist. The pharmaceutical sector, which had been brutally beaten down, falling 50% from 2015 to 2020, suddenly became the hero stock. Companies that nobody wanted to touch were suddenly delivering 500% returns. Now, ask yourself this: how is it that during the worst health crisis in 100 years, when hospitals were overwhelmed and people were dying, the pharma sector that should have been prepared for this had been crushed for 5 straight years? Who knew this pandemic was coming? Why were pharma stocks so cheap before the crisis? And why did retail investors suddenly flood into the market just when the economy was shutting down? These are the questions that nobody wants to answer, because in every crash, in every boom, it's the same story. Someone always knows something, someone always profits, and someone always pays the price. And that someone, it's always us, the common people. The middle class families who panic sold at the bottom, the small investors who bought pharma stocks at their peak in 2015, watched them crash for 5 years and sold just before the recovery. The retail traders who got overconfident and lost their life savings chasing meme stocks, while institutions and big players positioned themselves perfectly. Common investors were left holding empty bags, asking questions that will never be answered. Chapter 7. The pattern of destruction. After studying 100 years of financial destruction, here's the terrifying pattern. Stage 1. A new technology or economic policy creates genuine opportunity. Stage 2. Success stories attract more investors. Stage 3, FOMO, fear of missing out, replaces rational analysis. Stage 4, prices detach completely from reality. Stage 5, a trigger event causes panic. And Stage 6, liquidation destroys everything. Stage 7, years of recovery and rebuild trust. Stage 8, collective amnesia sets. And Stage 9, the average major market crash happens every 10 to 15 years. We have had tulips in 1637, railways in the 1840s, radio stocks in 1929, real estate in 2008, tech bubble in 2022, and many smaller crashes in between. The players change, the technology changes, human nature never does. So what's the lesson from 100 years of financial carnage? Markets crash, they always have, they always will. It's not a bug in the system, it's a feature. Booms and busts are as natural as breathing. The question isn't whether the next crash will happen, it's whether you'll be ready when it does. History doesn't repeat, but it rhymes. And right now, with meme stocks, crypto mania, and zero interest rates, it's starting to sound very familiar. If this video opened your eyes to the brutal reality of financial markets, subscribe our channel DISCVR AI for more deep dives into the dark side of investing. Hit the bell icon because next crash might be closer than you think.